Good morning and welcome. Everyone, thank you for joining us this morning. My name is Ralph Stewart. I'm the founder of Lifetime Retirement Income. The sponsor for today's discussion with Cameron Bagrie is Lifetime Asset Management. And the powers that be mean that I need to read out a bit of a disclosure statement. So if you forgive me, I'll just do that. Lifetime Asset Management is the issuer and manager of the Lifetime Retirement Income Fund. For more information, please find our product disclosure statement at lifetimeincome.co.nz. So powers that be, sorted out, and thank you. Now back to a good discussion. Today is all about inflation and how topical could that be after yesterday's announcements. We're very, very fortunate indeed to have Cameron Bagrie with us today. I've known Cameron for a number of years. Cameron has been an economist for I think now over 20 years, 11 of those with the ANZ Bank, some time with the National Bank, Treasury and Statistics New Zealand. I think you'll agree, Cameron is much loved for his frank and deliberate response to dealing with issues economics. Thought the best way to run this webinar was just to start with a bit of a context and introduction to how we're going to frame inflation in the context of retirement, then just have a bit of an interchange Q&A back and forward with Cameron. So in terms of introduction, yesterday was a big announcement. As you probably heard, the greatest increase in inflation in New Zealand in the last decade, almost 5%. The big movers were, as you might expect, construction, rates and transport all contributed to the increase. Inflation just really represents a basket of goods and services, which is measured from one year to the next in quarterly increments. So it was a substantial move. For us, though, today, given that inflation impacts and is measured across the economy generally, we just want to focus down on the impact of inflation on retirement and what it means for the good folk in retirement, because it is different. Spending patterns in retirement are different, and obviously the nature of our expenses are different. Equally, for many of us, we live on a fixed income, so quite different. So why don't we dive into some questions with Cameron? He's the one we want to talk to, really. So Cameron, if you're okay, can I start off with the first question?
Yeah, let's shoot, get into it.
Good stuff. The latest inflation increases yesterday, highest in a decade. What's going on, Cameron?
Well, there's a whole lot of things going on. Obviously, there's some temporary related COVID aspects. The supply chain globally is getting knocked around. With each passing day, though, it's looking as a little bit more persistent to those supply chain issues. Obviously, in the past couple of months, we've seen energy, oil prices have moved up a bit as well. People are now starting to think about, these remaining a little bit sticky for a long time as we start to think about underinvestment within the sector, investment alternatives in regard to meeting our climate change requirements. And that's going to add more costs as we start to think about alternative fuels. I think the CEO of Gull was out there on the television yesterday as well, talking about that. But if you look at the bigger picture, inflation is just symptomatic of a mismatch between supply and demand. So in the past sort of 12 months, you're patting the back to the team of 5 million. Monetary policy has delivered a big injection. Fiscal policy, the government's been spending an awful lot of money. So we managed to bounce the economy back through a demand lens. People are out there spending, having a good time prior to the lockdown. But what we've also seen is the supply chain. The ability of the economy to grow to meet demand is constrained in a COVID world. And it's not just about getting stuff in and out of the country. We've seen a big uplift in the number of people on the job seeker and broader benefits, despite the unemployment rate being down at 4%. And that's telling you there's actually some structural problems that are starting to intensify across New Zealand. But when you get a mismatch between demand versus supply, prices are going to go up. And I guess everybody's been surprised at the extent of that surprise on the top side. The big issue going forward is that how sticky, how persistent is it going to be over the next couple of years? And what's the Reserve Bank going to do about it?
Yeah, I agree, Cameron. The notion of supply and demand, everyone's different. So their demands are different and their calls on supply are different. I'd imagine the characteristics of demand in retirement are very different for someone in the workplace. What are your thoughts on the supply-demand mismatch for retired people?
If we look at, probably easier to think about that through cost of living, for different quartiles, income groups of New Zealand, beneficiaries, retirees, people earning high incomes versus low incomes. And what you tend to see is that the cost of living, one size does not fit all. So what we're seeing consistently for a long time is that inflation for beneficiaries has tended to be above the general cost of living for other parts of New Zealand. Why? Because housing costs, the likes of rents, tends to come pretty strong for that. What we also tend to see is that superannuation cost of living costs tend to be a little bit higher as well. Why? A couple of aspects: health-related costs, insurance. Other big one tends to be rates. Rates always tend up some magically to go up in excess of the general rate of inflation.
Yes.
Whereas what you tend to see is that so some groups, particularly higher income groups in New Zealand, you've tended to see average inflation rates slightly below the average inflation rate across the general economy. And a lot of that has just been because where we're seeing an awful lot of deflation or low inflation has been imported goods. All the fancy toys, all these sort of things, well, they went down for a long time. That trend now looks like it started to reverse because everything is going up, whether it be domestic produced stuff or the stuff that we're importing from across the border.
Yeah, no, indeed. But part of the household basket for a retired person, as you point out, mate, it's some of the basics in life, just getting from one fortnight or 1 month to the next. For example, food. I would imagine that petrol prices and transport is going to be pretty extreme on future inflation on the price of goods on the shelves.
Yeah, but potentially. And this is where we risk getting into what's called the second round effects. If the Reserve Bank sees a one-off spike in petrol prices, they're not going to get spooked. Now, they'll look through that. Odds are prices go down at some stage down the track and you don't have a persistent inflation problem. But if we start seeing those second round effects and even the third round effects, the second round effects is when you start seeing higher transport costs, then they start to appear in the cost of retail goods, or they start to appear in the cost of stuff on the supermarkets. The real big one to keep an eye on, though, is when you get inflation that's a little bit persistent and sticky, that it starts to shape what's called pricing behaviour, starts to make people adapt what they think inflation is going to be like going forward. And the big one we're going to be watching over the next 12 months is the relationship between wages and incomes, because, sorry, not incomes, inflation. Because inflation's 4.9%. So if you're not getting a 4.9% pay increase, then you're actually going backwards. Yep. Inflation's a thief that's taking money out of your pocket. Now, the danger is that, and we've seen this historically 30 odd years ago, you're going to do a bit of a two-horse race. Inflation goes up, wages has got to match. Wages match, that puts cost on businesses, so the cost of stuff goes up on the other side. And then you see a little bit of tit for tat and you're off to the races. Totally.
One of the key aspects of inflation for retired people is, as you point out, mate, is medical inflation. It strikes me that that's a bit of an odd one. Is I guess it's not going to be influenced so much by supply and demand characteristics in product sense. It's just a function of aging and requiring medical services. Yeah. It's hard these days not to talk about COVID, but I sense COVID's going to have just another layer of impact on medical inflation. If we do, start to see greater rates of people rocking up to the hospital for help, that's going to distort, I think, the relationship between public and private sector in terms of the services they have to offer. I know there's a big interchange between public and private when it comes to nurses and doctors. And I guess getting elective surgery is just going to get harder. I mean, how do you see the notion of what is it we could possibly do to help retired folk with regard to medical inflation?
Well, the medical insurance healthcare is a really interesting one to watch, irrespective of COVID. So if we step aside from COVID, which has just been a bit of an accelerant, yep, I guess, to highlight, yep, how critically important some of those critical workers are across New Zealand, i.e. the nurses, exactly, the police, these sort of things. But if you go back and have a look at pre-COVID, New Zealand had underinvested in critical infrastructure, including the medical fraternity, for a long time. We were short on nurses. We were importing them all from overseas. Same with the doctors. Now, because of population aging, we're going to see intensified competition for people with skills, not just over the next 12 to 24 months. This is a 10, 20, 30-year story in regard to making sure you've got that critical infrastructure, people that are going to be able to meet the economy's needs, not just through an economic sense, but through a social sense. And the healthcare sector is going to be pretty critical in regard to that. And of course, what we saw pre the latest lockdown was that there was various recruiters in Australia that were turning up to New Zealand and knocking on the doors of the nurses. And that is going to intensify competition. What is going to take place? Well, odds are, the people are going to end up receiving more remuneration, appreciation, to be able to actually want to stay here in New Zealand. So it doesn't matter whether we look at a general cost, whether transport, whether it be rates, whether it be wages. What we're seeing at the moment is a lot of across the board, what I think is looking increasingly sticky, persistent strength to inflation. And the challenge for the Reserve Bank is how the hell do they get that genie back in the bottle?
Yeah, no, indeed. Sort of circling just back to the medical issue, because it's something we hear a lot about. And while we can't give financial advice, we obviously listen to financial advisors when they talk about medical inflation and what retirees can do. So just to share a bit of what we hear and see, one of the most common answers that we see is the real need to assess the type of medical policy you have, and particularly for those people with comprehensive cover, they might be better to consider a co-pay type arrangement and just focus on serious care to keep those premiums down. So at least the period between age sort of 68 to about 75.
Just to add, suddenly glass are full. So suddenly the increase in the medical premiums in the last 12 months don't look that bad compared to general inflation.
It's good. That's something.
It's not a great story, but it does. The gap doesn't look as stark, because a long time we've seen the general medical inflation has been rocketing along above the general rate of inflation. And so we go back and have a look at the past 10 or 11 years. Inflation in New Zealand's averaged about 1.2% per year. It's actually been too low. Medical related inflation has been massively on top of that.
Totally. No, helpful. Thank you. I think it's a concept most people grasp, but can we ask you to talk us through it? The notion of real inflation. We can see the interest rates have ticked up a bit already. 5-year TDs are just over 2% now, 2.15. But that's only the gross rate. With the inflation rates that we're seeing now, can you help our viewers understand a bit about real inflation impacts?
Yeah, well, if you look at the term deposit, what you can get at the moment in the back, there's just have a round number. Number up around 1.5 to 2.
Yep.
And that's provided you tie your money up for quite a long time, which generally speaking, I don't think people actually want to do. But let's just use 2. Now, if inflation's 5, so 5, 2 take away 5 is -3. Now that's the real number. Now that's the extent that you're going backwards. Now it's not just through investments, it's through your income generation as well. If you're not getting a 5% pay increase, then whatever your pay increase is, take away 5 is net how much you're actually worse off.
Indeed.
Hence, we're going to see a lot of pressure going forward in regard to a little bit of catch up with those general inflation numbers. A couple of key indicators we keep an eye on is what's called the general inflation rate, and also what's called the labour cost index. And the labour cost index is just a proxy for how much wage inflation is coming through the system. And what tends to take place is that employers, when they're going through a negotiation with the employees or employees with the employers, they'll all call the Reserve Bank and they'll ask them, what's the latest inflation rate? And that sort of becomes, well, that's the immediate break even in regard to what we need to target or you focus on. And then you have a little bit of wriggle room around that. So wages do tend to follow the CPI with a little bit of a lag. But problem here going forward, if you start to see that tit for tat, you've got the recipe, the potential for a fundamental inflation problem. And the fundamental inflation problem is going to be challenging for the Reserve Bank. So if you have a look at the moment, they're lifting interest rates despite the New Zealand economy. It's technically in a recession at the moment.
Crikey, okay.
It's what we call stagflation. Well, it's not quite stagflation because unemployment's still low. But we've got rising costs and we've got a stagnant economy, albeit we've got an economy that's still got a fair bit of underlying momentum.
Okay, come to stagflation in a second because that's useful and helpful. Trying to convert these good messages into ways to be able to help our good retired folk. If, as a result of what we know now, we can see that real inflation is negative. So when I go and spend my money every fortnight, I find it's buying less and less and less in the short run. We do know the Reserve Bank are targeting inflation at sort of 1 to 3%. So we know they're going to do something about the 4.9 it's today. What duration do you think that's going to be? Are retirees facing a negative purchasing power for years, many years, months? What's the sort of time frame you see for a reversal?
Well, the million-dollar question here, Ralph, is inflation pressure going to be transitory or a little bit more sticky? And most central banks around the globe at the moment seem to be having the view that it's going to be transitory. So you're not seeing other central banks quick out of the blocks like the RBNZ. You know, if you ever look at the likes of the United States, US Federal Reserve, their headline inflation rate's around 5 as well. You've got a whole lot of other jurisdictions globally that are seeing inflation rates in excess of 4. But the critical judgment for central banks, where you can pause and you don't need to react, if you say it's going to blow over in the next sort of 12 to 18 months, then technically you don't need to lift interest rates. Now, I think that's a real big judgment at the moment, because with each passing week, it looks like we're seeing more and more evidence that the supply chain is going to be a little bit more, not permanently disrupted, but quasi-permanent. Yeah, a lot of people talking about high energy costs around the globe in 2022. Yeah, so I think central banks in the next 6 to 12 months, they've got a bit of work to do. And it's going to be difficult because everybody loves to be the central banker when you're turning up to the party and you're pouring the drinks, which is what they do when they take interest rates down to record low levels and they print money and all that sort of feel-good stuff that they've been doing to help the global economy out. But when you've got inflation, it's a little bit more persistent. You need to turn from party popper to party pooper. And that's when, that is when it is really difficult for central banks because, lifting interest rates is not growth friendly. It's not going to be good for asset prices over the coming years. And central banks, I think, have got a real tough balancing act going forward. A strict interpretation of get inflation back to 2%. Not going to be great for asset prices. It's not going to be great for governments' fiscal positions. Now, you think about these governments around the globe that have got net government debt of up around 100% of GDP. If you take interest rates up 1 to 2 percentage points, you've got a fundamental problem in regard to how much the interest bill is then for the governments of the day. So pretty tough balancing act in regard to what central banks, I suspect, they're going to face over the coming few years.
Helpful, Cameron. Now, I forgot to mention earlier that we're very fortunate. Cameron's a member of the Lifetime Investment Committee, and that's the fundamental engine in our business that helps us manage our customers' assets to ensure we can draw an income down for life. So your comments, Cameron, about we need real inflation to improve for the lives of retirees. And at the same time, we need to manage the challenge of potentially a negative impact on asset prices. It's going to be a challenge for the committee.
Well, the magic sort of number for inflation is sort of somewhere between 1 to 3. Now, that's where a lot of the empirical research sort of says you're in that sort of zone, you're sort of okay. You don't want to sort of be headed down, below 1 or into negative territory, which Japan has been experienced for a long time. Because if you're in deflation and you think goods are going to get cheaper in 12 months, then you don't go out and spend any money.
Yes, exactly.
And that's the fundamental problem of deflation. But of course, you've got the flip side problem when you've got inflation, which is a little bit of excessive on the other side. And inflation's that thief that takes money out of people's pockets. It makes business, makes doing business, pretty difficult. Because if you do not have pricing leverage to pass on price increases, it hits margins.
Exactly.
It also makes life pretty tough for the government because technically inflation helps erode a little bit of the debt burden. You get a higher nominal economy. But of course, the money's going to be firing out the door for a higher inflation because everything's indexed. Now you think about those infrastructure costs, those projects that the government's got in the pipeline over the next 5 years. Well, they'll be going back to the drawing board and trying to redesign or think about, well, how are we going to contain these cost increases? What do the project costs actually look like? Yeah, from memory, construction costs within the CPI, they're up double digit. Yeah, so you're adding double digit numbers into your project pipeline over the next sort of few years. And you're not talking small numbers. You're talking big sums.
I often reflect on the relationship between the Reserve Bank and the government. And we've seen this year, the first time I've ever seen it was sort of a letter of intent from Grant Robinson to the Governor of the Reserve Bank, sort of setting out what he thought about the role of the Reserve Bank. Given the increased debt the government's facing and the Reserve Bank's role in setting interest rates, feels like a bit of a conflict.
Yeah, well, if you like, the Reserve Bank has got independence. And that's a pretty critical element to give them credibility.
Yep.
But of course, that independence resides at the luxury of the government of the day.
Yes.
Because it's operational.
Yes.
And I guess if you want a real-time manifestation of that in reality, the Reserve Bank, I think, pushed the playbook last year too hard in regard to what they did, in regard to printing money, interest rates. They overshot interest rates going down too low. Now, what they did was that it took asset prices, i.e. house prices, up 30% in 12 months. So housing was a big sensitive social issue pre-COVID. Well, they just poured a whole lot more petrol on that fire. Housing market became more unaffordable or unattainable to big parts of the Kiwi population. So lo and behold, the Reserve Bank has now got a soft housing instruction within what's called their remit. Their main targets are still inflation and what's called full employment, or maximum sustainable employment. You're trying to get as many people into jobs as you can without stoking the fire of inflation. But they now need to regularly assess what the impact of their actions is on the property market. And that's just an example where you sort of go too far on a whole lot of levels. Well, the government can sort of check you in some shape or form.
Yes. Okay. So question of understanding really, Cameron, is, am I right? I think that consumer price index and the inflation calculation is exclusive of the existing housing stock. It's just new construction.
Yeah, so what's in there? House prices are not in there, interest rates are not in there, but what's in there is construction costs and rents, real estate agents' fees, you name it. All the derivatives that relate to housing are within the CPI.
Okay.
And what we've seen in the last 12 months is that the housing component of the CPI has been one of the strongest. In fact, it's typically persistently strong. So if you sit there, you think about there's a pretty strong economic incentive in front of the government at some stage in the next sort of couple of years to have a pretty close look at the construction sector. They're having a look at the supermarkets at the moment.
Yeah, true.
So I suspect they're going to pivot their attention of the Commerce Commission is going to shift to the construction sector pretty quickly in 2022 after they've finished the supermarkets. To keep inflation contained, low. It's not just about limiting demand, which is what the Reserve Bank does when they lift interest rates.
Yes.
We actually want to get supply up across New Zealand. Offer people more choice. Let's get that supermarket operator up and running. What are the mechanisms that need to take place in regard to driving competition across New Zealand? Because who wins out of that? It's the consumer.
Yes. Indeed. I was fortunate enough years and years ago to have a bit of time studying and working in London. And Aldi was there in those days, which is a low-cost supermarket provider. And it was just so far below the big three, the Sainsbury's of this world. It was fantastic.
Well, each time I used to go to UK, when I was up there, ANZ Chief Economist sort of job, we used to be flabbergasted at the cost of the items in the supermarket compared to what we were paying back home. Just mind-blowing in regard to where it sits.
Yeah, no, indeed. That'd be fantastic. Have some more competition, agreed. In a number of markets too, right? Even the fuel market. I know they've tried. I think Was it the national government who had a crack at that, trying to identify what was the true cost of fuel at the pump?
Yeah, Labor had a crack at it. It
was Labor
2 years ago. Yeah, big one over time, and this is a big one for retirees, is electricity costs.
Yes.
Yeah, just making sure we got a reasonably functioning market on that front, and it takes a long time to get markets truly operational. But quite often, look, politicians, they tend to focus too much on the bigger picture sort of things. The nuts and bolts of an economy is actually what we call microeconomics.
Yes.
It's all the small things. How much competition can we get into the electricity retailing industry? Because that supports choice, supports a better value proposition. The ability to shop around supermarkets. What are some of the big fundamental problems we've got in regard to the construction sector across New Zealand? Do we need more competition? The answer is yes. Issue, how do we achieve it? Commerce Commission in I think the 2019 budget from memory, they got, 2020, they got given an additional $30 million. Now, your 30 million within the context of a government that's spending more than $100 billion a year is actually pretty well chump change. But you think about what they could do with that in regard to driving competition across New Zealand to benefit New Zealanders. The more money we keep in our pockets, the better off we are. That gives us more money to redeploy and spend in other areas. Yeah,
no, indeed. Just an anecdote, really, but at the micro level, at our household, my wife manages our money. And recently, about a year and a half ago, we signed up to a new innovative electricity supplier, which effectively bought electricity from the wholesalers and then repriced it according to supply prices. And they've literally been squashed out of the market now because they can't buy the price, electricity cheap enough to pass on to us as they promised.
Yeah, well, what you tend to see is that, and regulators need to be onto this, is predatory pricing practices.
Yeah,
I can remember an airline out of Hamilton, Kiwi Air.
Yes.
The big New Zealand company just squashed them.
Yeah, no, indeed. Yeah. Many of the viewers today, I think, will remember the 70s and interest rates of 18, I got to a peak of 19%. You mentioned stagflation before. Is there any relationship between now, the 70s, and the emergence of stagflation?
Yes, so let's have a look at what actually is stagflation in the first instance, right? So stagflation is the combination of a stagnant economy and higher inflation.
Clear.
So if we look at that technically in regard to what we've got across New Zealand at the moment, we probably satisfy decent parts of the criteria with one exception. And so we've got, obviously inflation's moving up. It's single digit, it's not high double digit, but it's still moving up. And we've got stagnant growth. Now we've got stagnant growth, albeit off a really high level. So we had a really good first 6 months to the year. The other thing which typically defines stagflation is rising unemployment. Now New Zealand doesn't have that. We've got 4% unemployment. In the past 3 weeks, I've seen the number of people on the job seeker benefit has come down, which is a remarkable achievement when you look at, we've still got 1/3 of the New Zealand economy that's operating at alert level 3. So that just gives you an idea about how big the problems out there across New Zealand at the moment in regard to finding skilled and unskilled staff. There is work for Africa, despite a huge number of people still remaining on a benefit. Yeah, 1 person in 9 in New Zealand is on a benefit. And I'll say that again, 1 person in 9 of working age. Well, that gives you an idea about how big the structural problems are. Now that said, and if you go back and have a look at the 1970s, look, we saw an energy shock. There's a bit of talk about 2022 in regard to an energy shock. What we also saw was an awful lot of government spending. What we're also seeing at the moment is an awful lot of government spending. So there are broad similarities we can draw between now and what we saw in the 1970s, although the magnitude is nowhere near as intense in regard to what we're seeing on the inflationary front. And we are not seeing that collateral damage coming through the labour market.
Okay. That's fine. The notion of 1 to 9 and the relationship between younger people and older people and the demographic, etc. I want to try and find some positive aspects as well. Hold the view that for those in their 70s today, or perhaps late 60s, they need not worry that New Zealand superannuation will be changed or altered in perhaps the next 10 to 15 years. Is that a fair statement in your mind?
I think economic reality is going to kick in at some stage. There is going to have to be some changes. What those changes are and who wears the cost is the million-dollar question. So if we just sit back and look at some basic numbers, there's about 800,000 people at the moment that are aged 65 plus.
Yes.
Yeah, 30 years out, yeah, that's going to go to about 1.5 million. It's just about going to double. So you're going to see New Zealand superannuation costs are going to move up rapidly. The other one is going to be healthcare. So healthcare is going to go from about 6% of GDP to probably up closer to 10% of GDP. So the combination of rising New Zealand superannuation expenditure and rising healthcare costs are going to potentially chew up a fair bit of the government's tax take. Now, if you look at it through the Treasury's long-term fiscal projections, unless we change tax settings or crunch some other form of government spending, then we're on an unsustainable debt path. Now, if we accept we're on an unsustainable debt path, the conversation needs to be, what are we going to do about it?
Clear.
And these are the levers. Yeah, you can think about, well, constraining New Zealand super through some shape or form, maybe lifting the retirement age, which typically gets put on the table time and time again. If we could get a more efficient, dynamic health system, that could really help. Can we restrain other forms of expenditure? Okay. The more you support healthcare superannuation, is that less money we want to put into education? The next generation of kids. I think the inevitable lever that will get pulled going forward will be tax rates. The tax rates will follow the Edmonds cookbook and be sure to rise. But the one we'd like to see, and this makes the numbers stack up, if we can get more growth across the economy, a more dynamic, functional economy, get those number of people on the benefit down, so the supply side capacity in New Zealand to grow is increased. We're getting a stronger economy. We're doing a lot of innovative, more dynamic stuff. Grow the tax base. Wellbeing needs an economic base. Bigger economic base means we can support more social priorities going forward. So we're always better if we can pull that growth lever. That's the one we want to pull. But the problem is you need a bit of a plan for that, and we don't have too much of a plan.
Yeah, helpful, Cameron. Is it fair to say that Jacinda's team of 5 million is equally important for the economy as it is for COVID?
Well, look, on some levels, they've done exceptionally well, all things considered. Due respect in regard to the unemployment rate's back down at 4%. We haven't had that scarring in regard to all those people, lost generation of kids that could have potentially lost jobs. Borrowing to support the economy has been the right strategy. It's going to create a bit of a problem down the track, but we'll sort that out sort of down the track. The big failings are still execution. What we're seeing in regard to the economic versus the social ledger. And to be fair, it's not just the incumbent government. I think we've got a few issues across the entire political spectrum. In regard to what is the actual economic plan for New Zealand? What does it look like going forward? Because if you look at COVID, COVID is an enduring shock that is going to impact living standards. We're technically not as wealthy as what we think we are, because we've now got to learn to deal with this thing. We had the fun and games for the past 12 to 18 months. Reality hasn't quite sort of sunk in regard to what dealing or living with COVID actually looks like. And it's an environment that's going to be a little bit more challenging. And it means we just need to adapt. And the sooner we adapt and to the new sort of normal, whatever that's going to look like, well, no one knows. But what we know is that there's critical stuff, right? Get the vaccine rates up. Just mandate it. Traceability, vaccine passports, all these sort of things. The rest of the world's opening up, and we're still lagging. We had yesterday's party. The global economy is having tomorrow's party.
Really helpful. I mean, maybe we snip it for some of the listeners here today is that perhaps the spending and borrowing approach was the right thing, but the burden of that will really be on the younger people, not the retired people. That'd be fair.
Yeah, and this is, if you look at, well, here's something to think about as well, because there's a fair bit of racial tension out there across New Zealand at the moment as well, and that sort of stuff worries me, because when you get a divided economy, you actually get, when things get divisive, it becomes unhealthy.
Yep.
And you don't get a centralist political platform in regard to driving decent change. Yep. Yeah, but if you ever look at superannuation's a pay-as-you-go scheme. Okay, there's the New Zealand Super Fund out there that sort of tops it up, but it's basically pay-as-you-go. We pay for it out of the existing tax base. Now, if you ever look at what's happening to the workforce of New Zealand over the next sort of 30 years, the number of kids coming, or an increasing share of the workforce is going to come from Maori Pacific Islanders. Higher fertility rates, faster population growth in Auckland, these sort of things. So here's and if you look at who typically lives a little bit longer, it tends to be white Pākehā.
Yep.
So here's what's going to be going on. There's going to be more Maori Pacifica taxpayers supporting Pākehā retirees.
Oh, what a thought. Cam, that'll get some minds excited, mate. Crikey.
But that's just, that's an example of some of the stuff that people are not thinking strategic. But we've got some real big, hard decisions to think about here in regard to intergenerational equity.
Yeah, no, completely.
Right? Well, these things require big, tough, bold decisions to get stuff on the table.
Totally, mate. Don't want to not emphasise the point you just made, which are critical. Just want to go back to one point you made about the role of NZ Super offsetting effectively the tax impact in the future, potentially to support NZ Super. NZ Super just recently announced their financial performance for the last 12 months, and it looked to me that on average they'd been doing about pretty regularly sort of 4 to 6 times inflation as an investment return, which is pretty good, and it helps the tax burden a bit. If inflation's at 5, they can't be able to do that in the future.
No, and then everybody's got the same problem going forward in regard to what is investment returns going to look like.
Yeah, totally.
In the next sort of 10 years. And odds are at some stage there is going to be a bit of a quasi-accident in regard to markets. They're going to split the dummy. Does anyone know with certainty when that is going to be? The answer is sort of no. But when that happens, you've got to sort of stick your knitting in regard to making sure you've got the right strategies in place to deal with those sort of things, and you don't go through the panic situations which can typically tend to take place. The New Zealand Super Fund, its legacy has not just been about getting those strong returns. What it's actually done is it's generated a pool of capital, a pool of money domestically, so that when some New Zealand firms have gone on block to be sold, they've actually had the money to buy them and actually do pretty well out of it. So if you look at some of the investments that the New Zealand Super Fund has purchased or bought into in New Zealand over the past sort of 10 years, they've hoovered up some pretty good New Zealand-based investment assets and unloaded them at the wrong time. Sorry, at the right time.
Yeah, I get it, mate. Get it. That's an interesting point too, is sort of the role in government in funding NZ Super through taxation to grow. Get that. The immense impact that KiwiSaver's had on the New Zealand financial services sort of platform. Just
Michael Cullen's legacy.
Totally. Those two things combined, people are now, financial services is so bad for its acronyms, but this latest acronym is TINA. There is no alternative. So in other words, the likes of NZ Super and KiwiSaver funds that are getting regularly funded have to buy shares and bonds because there's nothing else to buy, in particular shares. So that event that you're talking about in the future, just wonder that could be quite catastrophic in a situation.
Well, this is the tough environment that we sit in at the moment. Real returns, if you look at bonds or cash, are negative. Interest rates are moving up, which technically is bad for asset valuations. If you think about one of the fundamental drivers of asset valuations is just discount rate. So if you look at in the past 12 months, we've seen one of the biggest increases in the past 20 years in the 5 and 10-year New Zealand government bond. Yeah, they're up at 170, 180 basis points in 12 months, which is an absolutely big, large move. Now, at the moment, we're not seeing equities are getting revalued on higher discount rates.
Great.
Right, but you start to think at some stage, if your interest rates keep on moving up, but they remain negative, can firms continue to deliver the earnings growth to justify the valuations?
Clear, hard.
Because earnings are going to be squeezed by margins. So there's a lot of good stuff that's going on out there. I'm pretty bullish on the likes of the health sector. And when you go through tough economic times, you can quite often go through big technological upswings in regards to big uptakes, big productivity sort of shifts. And you think about biotech, all these sort of things. But you just go back and have a look at the past 12 to 24 months in regard to what's happened to asset valuations as interest rates move down.
Yes.
And the market seems to be insensitive to interest rates moving up on the other side. Now, maybe we're going to get to that sort of point and no one knows. But what we do know is that you need to be pretty alert at this juncture because the risk profile is moving up. There's more risk in the system today than what there was 3 to 4 months ago.
Do you think it's a fair observation? The retired people that we work with, obviously volatility and rapid changes in prices is disconcerting, and it doesn't help at all, particularly when you're trying to forecast an income for life. When we did have the COVID effect back in March 20, the downside on the market was immense. The recovery was rapid. You think we're going to a period of increased volatility? We won't have that event you're talking about, but the recovery from that event will be faster than we've seen in the past. Well,
you just have a look at what we've seen in the past month. We're starting to see markets are a lot more zigzaggy from night to night. Big issue for markets at the moment, because last year we had what's called the V-shaped recovery. Why was it a V? Because policymakers went really big, and New Zealand in particular, we managed to stamp the thing out. Well, we're now dealing with the endemic variety of Delta as opposed to the pandemic.
Yes.
And it's a fundamentally different story. And I just was watching CNBC before I jumped on this, and former head of the FDA is now talking about some other Delta variant that's suddenly starting to do the rounds.
Another one.
Now this is just reality in regard to what the new normal is going to look like. So we're going to have to. COVID to me is just one of many disruptors.
Yes.
So you think about the fourth industrial revolution.
Yes.
You think about managing climate change risks. You think about managing some of the rebalancing we need to get back between the economic versus the social ledger. Because if you get too far out of balance, you get an unhealthy society, which is not a society that's good economically either. And so there's a whole lot of adjustments that need to take place where you can be glass half empty about them, where you can be glass half full.
Yes.
But there's certainly going to be a lot of volatility going forward. China's numbers are coming out with each passing day, and China's now suddenly underperforming, which is unusual for China. People are focusing on Evergrande in regard to where that goes to. A lot of articles come out overnight as well about your rising energy prices across Europe. What's that going to do to the consumer? So there's no shortage of opportunities or challenges out there to focus on.
Yeah, no, indeed. Glass half empty, glass half full is a good analogy. Part of our ethos is to ensure that retirees have a worry-free retirement. So finding ways to translate, the glass half full and to participate in the initiatives that help to support that's important for us.
Yeah, well, I guess it doesn't matter whether the glass is half full or glass empty. You're still going to take a sip.
And it's just water, right? Just mindful of time. It's now 10:45. A couple of questions have been posted while we've been talking, Cameron, so I might go to those if you're okay. The first one is, why doesn't New Zealand join the majority of the OECD with indexed personal tax-free allowances? I'm just thinking through what that is. Actually, there's an example. At 25,000 low-income earner, beneficiaries and superannuants would move out of the lower tax band. So
it's just tax-free. It's just
another tier, I think.
I think the immediate challenge to New Zealand would just be the cost.
Yeah, no, indeed.
Yeah, you sit there and think about it a little bit more. Yeah, bigger picture. Yeah, there's no optimal size of government, right? Yeah, whether the government tax to GDP is 35 cents in the dollar or 30 cents in the dollar, we're not quite sure what is right. What we do know is it makes a pretty big difference in regard to the quality of the spending on the other side.
Yeah, no, I do.
Yeah, so yeah, I wouldn't mind paying more tax if I was going to be assured that that money was going to go into early childhood education and primary school education. Because I think that if it's delivered right, it's going to deliver big economic payoffs down the track. You know, there's other parts of spending I wouldn't be keen on contributing to because I think it's low value add stuff.
Yeah, no, indeed. I do think the question points to an important area for retirees, though, is retirees don't have that luxury. You know, by and large, they've stopped working, so they're relying on the tax system supporting them. Yeah, I think the question calls out, while it might be a cost-driven issue, you know, is there an allowance for people who really need it? Who have
well, you got a fundamental problem here that retirees can be asset rich and cash poor.
So exactly.
All right, and one of the things that I think is inevitable in New Zealand over the next 10 to 15 years is that equity release products for the house are going to become commonplace. And I know there's a lot of bit of concern about them at the moment in regard to the reputational risk of them. Yeah, but you put appropriate parameters around that in regard to making sure there's checks and balances and there's limits in regard to how much equity release you can actually undertake.
Yes.
Yeah, but these sort of products, look, who's going to begrudge anybody for paying the electricity or the medical insurance and just paying for it through some equity release product? The odds are the value of the house is going to go up more than the loan. In fact, you'd have to have a lot of debt for your equity to be going backwards, even under a scenario where house prices are moving up really slow.
Yeah, completely, Cameron. In our world, we get an inquiry at least every couple of days around just a simple aspect of how can I release a little bit of equity out of my home, have certainty about what the remaining equity will be to supplement my income. It's just dead obvious to me. Listen, just again, mindful of time. I think we're going to close off at this point. Cameron, are you okay to finish here?
Yep, no, good to go, yeah.
People have joined us this morning. Very grateful. Thank you. I hope this has been helpful and informative. Cameron is on the Lifetime Investment Committee, so if you have specific questions, I'm sure we can channel them through to Cam and get you answers. If you'd like to learn some more about what we do at Lifetime, lifetimeincome.co.nz is where the answers are. We're very pleased to help where we can. So thank you, Cameron. Always great to talk, mate, and always learn so much. Thank you very much. And to those people who have joined us, it's been a pleasure. Thank you very much indeed. Hope to see you again. Bye-bye. Camo, fab, mate.
Thank you.